Right now, if you turn on any financial news channel, open any investing app, or scroll through any market commentary, you'll see the same thing. Red, fear, warnings, soaring oil prices, inflation dominating the conversation, and recession predictions from analysts who seem more certain each day that a catastrophe is approaching. But here's what I need you to understand before we go any further. That feeling you're experiencing right now, that sense of discomfort, worry, perhaps even slight panic when you look at your portfolio or read those headlines, that feeling isn't a red flag telling you to run. Historically, consistently, and demonstrably, that feeling is one of the most reliable signals that a massive wealth-building opportunity is either already here or just around the corner. Welcome to Economic Awakening, where we decode the noise to find true opportunity. I've spent years studying market cycles, analyzing decades of data, and what I'm seeing right now, this specific combination of fear, uncertainty, macroeconomic noise, and profound structural transformation almost perfectly mirrors two other moments in modern financial history. Two moments when investors who kept their heads while everyone else panicked went on to build the kind of wealth that changed their families' trajectories for generations. I'm going to show you exactly what those moments were. I'll reveal why this pattern is repeating right now. I'll share the strategy that transforms this volatility into an advantage, not a threat. And then, I'll show you where the real money is hiding in this market. Not in the obvious places, not where the crowd is already looking, but one layer beneath, in a corner of the economy so critical and so underestimated that most retail investors will miss it entirely. Stay until the end, because the last part of this video, what I call the picks and shovels opportunity, is what professional fund managers are quietly discussing amongst themselves while the general public panics. If this kind of pattern recognition analysis resonates with you, consider subscribing and hitting the notification bell. We deliver this type of insight every week here at Economic Awakening. Let's start with what's actually happening, because I don't want to dismiss these concerns out of hand. They are real. Rising oil prices absolutely matter. When oil prices surge, the cost of everything else climbs with them: transportation, manufacturing, food, energy bills. This fuels inflation, and when inflation rises, the Federal Reserve increases interest rates. When interest rates climb, borrowing becomes expensive for businesses, for consumers, for the entire economy. Growth slows, and people start whispering the same word they always whisper in times like these: stagflation. High inflation, stagnant growth, high unemployment. The nightmare scenario, the ghost of the 1970s. But here's what you absolutely need to understand. True stagflation is one of the rarest macroeconomic events in modern history. Not because it can't happen, it can, but because the conditions required to sustain it are extremely specific, and those conditions simply don't exist today. Back in the 1970s, the Federal Reserve was slow, bureaucratic, and reactive in the worst possible way. They saw inflation coming and stood by. By the time they acted, the damage was already deeply entrenched. It took Paul Volcker raising interest rates to nearly 20% to kill that inflationary cycle, causing a brutal recession in the process. That Federal Reserve no longer exists. Today's Fed is fast, data-driven, and frankly, obsessed with avoiding a repeat of that era. They have all the tools, all the incentives, and all the historical lessons needed to react swiftly. Between 2022 and 2024, they executed the most aggressive rate hiking cycle in 40 years, specifically to avoid a 1970s-style outcome. So when you hear the word stagflation in the media, here's the translation. Journalists are using a scary word to describe uncomfortable but manageable conditions. Discomfort is not the same as danger, and in investing, discomfort is almost always an opportunity. Now I want to show you the historical pattern, two moments that prove what I'm about to tell you isn't theory. It's pattern recognition backed by concrete data. First moment, 2002 and 2003. The dot-com bubble had just burst. The Nasdaq had lost nearly 80% of its value. Trillions of dollars in wealth evaporated. Then 9/11 happened, followed by Enron's collapse, then WorldCom. Newspaper headlines were apocalyptic. The general sentiment was that the stock market was broken, technology was dead, and we had been fools to believe. What happened next? The S&P 500 embarked on one of the greatest bull markets in its history. From 2003 to 2007, it gained over 100%. Investors who kept their cool, or even better, doubled down at the bottom, achieved generational returns. Second moment, 2009, the global financial crisis. Banks collapsing, the housing market in freefall, unemployment soaring past 10%. Lehman Brothers gone, the U.S. government bailing out the entire financial system. The headlines weren't just scary, they were existential. The general sentiment was that capitalism was broken, the system was over, that this time was different. What happened? The S&P 500 bottomed in March 2009 and then delivered one of the longest bull markets in history. Over the next decade, it gained more than 400%. Investors who bought when everyone else was fleeing for the exits didn't just recover, they built serious wealth. Do you see the pattern? Moments of maximum fear, the moments that feel most dangerous, most uncertain, most different, are consistently and historically the early stages of the next great wealth creation cycle. This isn't a coincidence, it's a function of how markets work. When sentiment is terrible, prices are low. When prices are low, future returns are high. It's not complicated, it's just profoundly uncomfortable to act on. If this kind of pattern analysis provides you value, consider joining the Economic Awakening community. We cut through the noise and find the signal. Okay, you understand the macro environment, you understand the historical pattern. Now, let's talk about what to actually do with this information. Because understanding the pattern intellectually and acting on it emotionally are two completely different things. Watching your portfolio drop 10%, 15%, 20% isn't just a number on a screen. It feels like losing. It feels like failing. Your brain screams at you to stop the bleeding. The standard advice is dollar cost averaging, or DCA. You invest a fixed amount on a fixed schedule, say $500 every month, no matter what the market does. It's a historically effective strategy, and it removes emotion from the equation. But I want to introduce you to something even more powerful. I call it Double Down DCA. The concept is simple. You maintain your regular investment schedule, but when the market drops significantly, specifically around 10% corrections, you increase your allocation. You don't panic and sell. You don't get paralyzed. You accelerate. Why 10%? Because 10% corrections are, historically speaking, extremely common. They happen about once a year on average. They feel catastrophic when you're in them, but in the long arc of market history, they are completely normal. It's volatility, not collapse. Here are the mathematics that make this powerful. Imagine you normally invest $500 a month. The market drops 10%. Instead of $500, you invest $1,000 that month, or even more. You buy more shares at a lower price. When the market recovers, and historically it always has, those extra shares you bought at a discount deliver outsized returns. You are literally turning fear into fuel. The psychological barrier is real. When everything seems to be falling apart, the instinct is to preserve capital, to hide in cash, to wait for clarity. But here's the brutal truth about cash. Cash has a hidden enemy: inflation. Every year your money sits in a savings account while inflation erodes its purchasing power, you are slowly, silently losing. Over 5, 10, 20 years, the destruction of purchasing power due to staying in cash isn't theoretical. It's devastating and almost completely invisible. Staying in cash doesn't feel like a decision, it feels like doing nothing. But it absolutely is a decision to lose slowly. Now, I want to zoom out because one of the biggest mistakes investors make, especially during times of volatility, is losing perspective. They get so fixated on the daily noise that they forget what the long-term data actually shows. The S&P 500, over any rolling 20-year period in its history, has never delivered a negative return. Never. Through wars, recessions, oil crises, financial crises, pandemics, geopolitical shocks, over a 20-year horizon, the market has always gone up. This isn't blind optimism. It's the most rigorously tested and historically consistent data set in modern finance. Why does this happen? Because economic growth is humanity's default condition. Populations grow, technology improves, productivity increases. These aren't cyclical phenomena, they are directional. Over long time horizons, the economy expands and markets reflect that expansion. And this is where it gets particularly interesting for the current moment, because we are in the early stages of a technological transformation so profound it makes the internet era look like a dress rehearsal. I'm talking about artificial intelligence, and I'm not talking about what most people imagine when they hear that phrase. I'm not talking about chatbots. I'm not talking about image generators. I'm talking about the fundamental redesign of how the global economy processes information, makes decisions, and allocates resources. This is the new layer of demand, the new engine, the thing that will power the next great market cycle in the same way the internet powered the one that began in the late 1990s. But, and this is absolutely critical, the way most people are thinking about investing in AI is completely wrong. There's an old story from the California gold rush of 1849. Hundreds of thousands of people flocked to California looking for gold. Most lost everything. The people who got rich weren't the miners. They were the people selling the picks and shovels. Levi Strauss didn't look for gold. He sold denim pants to the miners. He built one of the most valuable companies in American history. This principle, finding the infrastructure, not the end product, is the most reliable framework for identifying massive market opportunities, and it applies directly to AI. Right now, everyone is chasing the obvious AI bets, the software companies, the applications, the consumer chatbots. That's where the crowds are. That's where valuations are stretched. That's where you're paying a premium for hype. The real opportunity is a layer beneath. It's in the infrastructure that makes AI possible. Let me break this down into 3 specific areas. First infrastructure layer, energy. Here's a fact most people don't grasp about AI. It is extraordinarily power-hungry. Training a large language model can consume as much electricity as thousands of homes use in a year. Running AI inference, the actual process of using a trained model at scale, requires data centers consuming megawatts of continuous power. According to multiple industry analyses, AI-powered data center energy consumption is projected to double, even triple, over the next 5 years. The electricity grid is not ready for this. Energy companies positioned to meet this demand, power producers, utility infrastructure providers, companies building dedicated data center energy solutions, are facing a structural demand shock. This isn't speculative. Microsoft, Google, Amazon, and Meta have already announced hundreds of billions of dollars in data center capital expenditures. Every single one of those dollars requires energy. Second infrastructure layer, hardware. You've heard of NVIDIA. The GPU story is well known at this point, perhaps too well known, which is why the valuation reflects enormous expectations. But the hardware story runs deeper than just GPUs. Network equipment, cooling systems, custom silicon. The physical architecture of data centers is being redesigned from the ground up to handle AI workloads. The companies providing this transformation aren't household names, but they're seeing some of the most explosive revenue growth in the tech sector. Third infrastructure layer, memory. And this is the one I really want to focus on. Memory is becoming the critical bottleneck of the AI era, and almost no one is talking about it. Here's why this is so important. The fundamental challenge of AI, especially as models become more complex, as AI agents multiply, as robotics become more sophisticated, isn't just compute power, it's memory bandwidth. The ability to move data into and out of processing units fast enough to keep up with computational demands. This has created an explosion in demand for a specific type of memory called HBM, high bandwidth memory. Unlike the standard memory in your laptop, HBM is stacked in layers, delivering data at speeds conventional memory architectures simply can't match. And right now, HBM supply is severely constrained. The manufacturing process is extraordinarily complex. The number of companies capable of producing it at scale is tiny. Micron Technology, SK Hynix, Samsung Electronics. These three companies are the primary suppliers of the memory upon which the entire AI revolution runs. And here's the extraordinary thing. Despite sitting at the most critical bottleneck of the fastest growing technology segment in history, two of these three companies were trading at valuations that imply the market hasn't fully priced in what's coming. Micron in particular has been through a brutal cyclical downturn in conventional memory markets. The stock has reflected that pain, but the forward-looking picture, driven by HBM demand from AI customers, is fundamentally different from the story that depressed the valuation. It's a classic example of the market looking in the rearview mirror while the windshield shows a completely different road ahead. SK Hynix positioned itself quickest for HBM adoption and has been rewarded. Samsung is catching up, but brings a scale and manufacturing depth no other company in the world can match. The memory market isn't glamorous. It doesn't generate viral headlines. It doesn't have a charismatic founder doing podcasts. But it is absolutely fundamentally essential to every AI application, every AI model, every AI agent, every AI-powered robot that will be deployed in the next decade. You don't need to bet on which AI application will win. You don't need to pick the right chatbot or the right model. You just need to recognize that all these systems, every single one of them, needs memory. And the companies supplying that memory are a picks and shovels bet on the entire AI ecosystem. If you want deep dive analysis on specific companies and sectors within this space, make sure to subscribe and turn on notifications. We go where mainstream financial media doesn't. Now, let me tie all of this together because I want you to see the complete picture, not just individual pieces, but why it all converges at this precise moment. You have a macro environment that appears scary on the surface: oil concerns, inflationary noise, recession talk. But beneath that surface, the structural drivers of growth remain intact. The Federal Reserve is better equipped than ever to manage inflationary cycles. Liquidity in the financial system, while tighter than the zero-rate era, is still active.